Cleveland Fed President Loretta Mester driving that price action today, Shauna, after saying in a speech, quote, "We have more work to do." The Fed president noting she would have favored raising interest rates by 50 basis points earlier this month rather than the Fed's decided 25-point basis hike. The St. Louis Fed president also backing the need for more rate hikes. The combination of these comments weighing on markets, as you saw there. So where do we go from here? Let's ask Amy Kong, Barrett Asset Management Chief Investment Officer. Amy always knows where we're going from here. Is a 50-point hike on the table?
Hey guys, thanks for having me. It's never off the table, but at this point, we think the probability of a 50 basis point hike is lower for a couple of reasons. The Fed has just announced a 25 basis point hike last month, and I think there needs to be a consideration of the consistency of the rate hikes going forward. The messaging is very important. And then second, I think it's still a little too soon to be calling for a 50 basis point hike. Yes, the CPI numbers this week were worse than expected. It does show that CPI is still moderating, but not to the degree that we're looking for. And we still have one more CPI data point until the next FOMC meeting. I think if we get further information that CPI is not moderating, or perhaps it goes higher, then to your question, maybe a 50 basis point hike would be a better possibility at that point. But for now, I'm still agreeing with the market in terms of a 25 basis point hike in March.
So, Amy, what does this mean then for equities? Because the market so far, they have been ignoring any rhetoric that we've been getting out from the Fed for the most part, also ignoring the action that we're seeing in the bond market. The gains that we've seen since the start of the year, do you think that momentum can continue if, in fact, inflation does remain pretty sticky, which it seems like it's going to?
Yeah, it's a great question because I think the markets have just gone a little bit ahead of itself. You can see that with the way the markets have been trading since the start of the year. Tech, growthier type names have started to come back. That momentum can continue as we're looking still through the earnings season. It's been less bad than expected. I think that could be a driver of that momentum. But as I've mentioned, the CPI numbers, PCE coming later next week, et cetera, FOMC meeting minutes, all of that can remind investors that inflation is not dead. And when you have start to see that kind of momentum, negative momentum come back into the market, again, what we can expect is just volatility coming back into the system going into the next FOMC meeting, which again is not for another 6 weeks.
It was welcome news that Goldman lowered its likelihood of a recession to 25%, which the brilliant Brian Sozzi phrased as 75% we don't have a recession. I appreciated that. You say that the probability has further increased. Why?
It's increased based on some of the leading economic indicators that we're keeping a very tight monitoring over. That includes sentiment. That includes new CapEx orders, money supply, things of that sort, are all suggesting that the collective data points have peaked sometime first half of last year. And history tells us that it typically gives us maybe 12 months, 15 months of lead time before the economy starts to going into a downturn. The data is conflicting, though, because you've got some softening corners of the market, including housing and manufacturing. But the jobs market continues to be very tight. We saw that with the jobs numbers. Retail sales were also surprisingly strong this past month. And so the data continues to be conflicting, and that kind of holds off the start, if you would, of the recession. But we still believe, though, that, again, some of these economic indicators, the leading ones, are suggestive that we could enter a downturn perhaps back half of this year.
Maybe the jobs report, especially last month, clearly painting a picture of a very resilient jobs market right now. But we have been hearing about, it seems like every day at this point, more and more companies that are announcing layoffs. Are we starting to see some cracks in that picture? And what do you think the hiring landscape then looks like as you look out to the remainder of the year?
Sure. There's been more headlines, as you can imagine, from the tech sectors. Tech companies, rather, they overhired during the pandemic and they're reversing course. So there's one argument there. But really under the hood, to your point, there probably are a lot of companies not making headlines, still slowly but surely right-sizing their employee base. And that does take some time to enter into the market numbers. What's been interesting is that the number of temp layoffs has been rising since July of last year, and that doesn't get talked about a lot. History, again, tells us that generally speaking, when CEOs and CIOs start to get nervous, the temps go first. And so it probably will take another quarter or two for us to really see some of these layoffs get into the numbers. But we are starting to see cracks in the system. Wage inflation is starting to come down a little bit. And so again, to us, this is likely the peak of the tightness, if you would. And we do expect that to moderate going into the back half of this year.
And if there's been a broad takeaway, a lesson we've seen throughout earnings, is it that you lower estimates enough you can leap over it, or what are you seeing?
The EPS has started to come down. EPS estimates have started to come down, but probably not fast enough. Looking at the estimates at the beginning of the earnings season versus now, estimates have come down maybe about 5%. We do expect that to continue. Keep in mind that the back half of the earnings season are mostly the retailers. And so that's going to be an important indicator of how strong, how healthy the consumer continues to be. And that's, again, very critical when it comes to the U.S. economy, given that it's majority consumption based. What's interesting, too, is the stock market tends to be more forward looking than that. And if you look back over the last 10 decades, if you would, the stock market actually starts to rise about 6 months before trough earnings estimates. So while earnings estimates can continue to move lower, the markets can be looking beyond that. So that's something to keep in mind as we think about stock price movements.
Very important to keep in mind. All right, Amy Kong, thanks so much.